That affects everybody. The federal interest rate increasing for the first time in 10 years. What does that really mean for your money? Well, Stewart Welch, our financial expert, is with us again today to talk about the good, the bad, and the ugly. He is our own Clint Eastwood.
That's right. Where's my theme music?
Yeah.
Okay. I love that.
All right, how you doing?
Perfect.
Okay, so we know that the Feds, it rose it just a little. That's not the big deal, right?
The big deal is how far, how fast. And what you see, if you study rate trends, you'll see that once they change rates, that rate trend is going to typically go for multiple years and it'll stay in that same direction. So you can anticipate not a quarter point rise, which we just had,
right,
but multiple quarter point rises over the next several years. And
that can really change things with people buying homes, your credit cards. So let's go through this. Let's first talk about the good. The
good, that's savers. Savers, particularly retirees, they've been waiting forever, it seems like, to get any money, get any earnings on their money. And so a quarter point, what you're going to see is CD rates have gone up. I checked this morning, rates have gone, the 5-year CD went from 2% to 2.25%. It's a little bit, but it helps. And I think what savers should do, money markets, you probably won't see that right away. The banks are going to wait and try to make a little money and a little more profit on that. But what you want to be careful of is locking too much money in too far out, because rates are going to rise beyond you. So you don't want to go put all of your money at a 5-year CD and then have rates continue to rise way beyond that.
So sit tight for a minute on that.
Well, I think what you do is a laddering strategy. You take your money, divide it into 5 parts, buy a 1-year CD, 2-year, 3, 4, 5, and then when the one matures from that point forward, you're going to just rebuy 5 years, and that way it'll help you track rates.
Okay, let's go to the bad.
The bad. That's going to be if you are a borrower. So lots of loans are tied to bank prime. Bank prime just went up 1/4%. So that would affect people with personal loans. That's people with home equity lines. That'll be.
So while you may have a good rate right now, potential it will move up.
It is going to move up, and I think what you ought to do is, if you have those kind of loans, you need to look at it and consider whether you should go ahead and convert it to a fixed rate. And probably going to be at a higher rate, but you're going to lock it in before rates begin to overrun you.
Okay. The bad or the ugly?
The ugly. So as interest rates rise, values of existing bonds fall. So if you own, a lot of people own bonds or bond funds in their 401k. As those rates rise, those bonds that they hold, you're going to see the value of those bonds go down.
So what do you do?
There's 2 things you can do. One is you can swap them out. Say, I'm going to sell the longer term bonds and get shorter term bonds. Or you can ride it out. And if you ride it out, if it's individual bonds, you just have some opportunity cost. You wait for them to mature. If it's bond funds, you're going to have to wait for the whole interest rate cycle to go through. That may be multiple years.
All right. It is something that it affects all of us, no matter
everybody's going to be affected by this.
Where you are somewhere in life.
Yes, everybody will be affected.
Good to see you.
Merry Christmas.
The good, the bad, and the ugly. Merry Christmas to you too.
Thank you.
All right. Still ahead.